This is Financial Markets, and this is our final hour. And we are still looking at some of the top stories making headlines. Now, the long-awaited Africa Free Trade Area takeoff delayed by 6 member states. 6 countries drawn from the 3 regional economic blocs are yet to ratify the African Continental Free Trade Area, that is the AfCETA, delaying its implementation more than a year after it was formally launched in January 2021. Now, the African Continental Free Trade Area is a brainchild of the African Union's Integration and Prosperity Agenda of 2003, which was supposed to create one large market for its member states. But more than a year after its inception, some countries are still dragging their feet in adopting to its legal framework in domestic laws. In the East African Community, South Sudan is yet to ratify the African Free Trade Continental Free Trade Area and the Southern African Customs Union. Botswana is yet to ratify deposit its instrument of ratification. A second coordination meeting of the heads of regional economic communities held in Arusha on June 7th was revealed that Benin, Guinea-Bissau, and Liberia, members of the Economic Community of West African States, that is ECOWAS, are yet to become state parties. Now, the SACU comprises of Botswana, Eswatini, Lesotho, Namibia, South Africa. Eritrea is yet also to become a member of the African Continental Free Trade Area member, making it difficult to discuss customs and trade offers within the continent. However, in the East African Community, Kenya, Uganda, Tanzania, Rwanda, and Burundi have ratified the agreement, while in the Central African Economic and Monetary Community, all the 6 member states, that is Cameroon, Republic of Congo, Gabon, Central African Republic, Chad, and Equatorial Guinea, are state parties to the agreement. While it is now possible for state parties whose customs procedures are ready to trade under the African Continental Free Trade Area, preferential terms no trading is taking place, there remain a few outstanding issues hampering our collective efforts to facilitate effective trading under the African Continental Free Trade Area preferential trading regime. That is according to Mr. Wemkali Mene, who is the Secretary General of the African Continental Free Trade Area at the meeting in Arusha. Now, many also said that the trade was yet to commence for a number of factors, including failure by all African countries to ratify the agreement, yet to be submitted of tariff offers, rules of origin, and trading documents. For instance, while the 54 AU member states are signatories to the African Continental Free Trade Area Agreement, only 43 member states have ratified the agreement and deposited their instruments of ratification of the agreement with the African Continental Free Trade Area Secretariat. And yet, according to the agreement, entry into force occurs 30 days after the 22nd instrument of ratification is deposited with the chairperson of the African Union Commission. 10 state parties and non-state parties, Comoros, Djibouti, Eritrea, Ethiopia, Mozambique, Libya, Somalia, Sudan, Tunisia, and Sahrawi Republic are yet to submit any tariff offer. They are working closely with the RECs to ensure all constituent members of the Customs Union become state parties in order not to adversely impact smooth implementation of the African Continental Free Trade Area and integrity of the common external tariff at the REC level. It is, of course, their expectations to have more ratifications before the year ends. As at May 31st, 45 of 55 countries of the African continent had submitted tariff offers to the African Continental Free Trade Area Secretariat, including submissions from CEMAC, East African Community, ECOWAS, and SACU, and some countries that had submitted individually: Algeria, Angola, Egypt, DRC, Madagascar, Malawi, Mauritius, Morocco, Sao Tome Principe, Seychelles, Zambia, and Zimbabwe. The East African Community Secretary General Dr. Peter Mathuki, who hosted the REC's meeting, decried the law intra-trade among African states and called on the speedy implementation of the African Free Trade Continental Area. And of course, that is a story we will be following up on the integration of the the African community to ease trade across its borders with other countries, and to see that many people actually start to benefit from this free trade area that is trying to be created by the African Continental Free Trade Area Secretariat, that is with the objective of trying to set the African market as a single market where people can easily transit goods and services across borders. Moving on to Tanzania, the budget, according to Tanzania's new tax targets, of course, Google and Facebook. Now, the Tanzanian government will introduce a digital tax this year, and the country's finance minister, of course, said in a move targeting global internet giants offering services in the country, that is Google and the like. The 2% tax will come into effect in July and follows similar attempts by other countries to force US multinational tech companies to pay at least a portion of their revenues in local tax. Tanzania's Minister for Finance and Planning, Mr. Mwigulu Nchemba, announced the measure on Tuesday as he presented the national budget. Tanzania Revenue Authority shall establish a simplified registration process to accommodate digital economy operators who have no presence in Tanzania. That's according to Mr. Nchemba to the lawmakers. This measure is intended to keep pace with rapid growth in the digital economy, he added. The tax needs to be approved by Tanzania's parliament, which will vote on the budget before July. The tax announcement follows talks in April between officials from the Tanzania Revenue Authority and the US social media giant Meta, the parent company of Facebook, Instagram, and WhatsApp. Nearly over 140 countries signed up for a 15% global minimum corporate tax, of course, in October, under the auspices of the Organization for Economic Cooperation and Development. Since then, more countries, including Turkey, India, have signed up the deal, which expected to come into effect in 2023. The historic agreement aims to put an end to the corporations sheltering profits in low tax haven countries. And of course, that is Tanzanian government. They are taxing Google and other international digital companies which have not been paying taxes to actually start paying taxes and giving off some of their revenue as tax to some of these countries. That's according to Mr. Mwigulu Nchemba, who is the finance minister of Tanzania. You can call him the Kamatia Kasaija of Tanzania right there, as he was presenting their national budget in the year 2022-2023 on Tuesday to the nation. And moving on to another story, of course, the current situation surrounding financial markets and oil, of course, has been to raise money for oil in a bid to see that we get a little bit more to finance our own oil company, that is the East African Corporation for the oil pipeline. And the government has said that it has committed 872 billion Ugandan shillings to oil financing. Government has allocated 2022 budget to oil-related activities, which signals commitment towards going through the development phase to achieve the first oil. Finance Minister Matia Kasaija confirmed the allocation during the budget speech, in which he said that government had fulfilled its earlier commitment that had been done earlier this year. The 872 billion Ugandan shillings will be shared with a number of oil-related government agencies, with 720 billion Ugandan shillings going to oil financing, while the Petroleum Authority of Uganda, the oil regulator, the Ministry of Energy taking 64 billion and 87.3 billion. Construction of the East African crude oil pipeline, Mr. Kasaija said, is expected to commence in the coming financial year, while the capacity of the Uganda National Oil Capacity to invest in oil and gas development has also been enhanced. While there have been negative campaigns against the development of the crude oil pipeline, government will develop the country's oil and gas resources in a responsible and sustainable manner for the benefit of all Ugandans. Mr. Kasaija also indicated that investment in the oil and gas sector had contributed significantly to the increase in the private sector imports to $6.4 billion for the period ended April, from $5 billion in the previous 12 months. Uganda National Oil Company, which handles the state's commercial interests in the petroleum subsector, holds about 15% participating interest in as government's nominee in the petroleum production licenses. Now, UNOC's shareholding and capital structure include the Energy Ministry with 51% shares, and as the Financing Ministry with about 49% shares. At the 5th UNOC Annual General Meeting held at the end of April, Mr. Kasaija had pledged to provide UNOC with the remaining equity for the oil pipeline and refinery when it is due. And of course, the reiterating government, the government is committed to ensuring that UNOC is sufficiently funded as the country seeks the first oil by 2025. UNOC is also expected to undertake stocking of about 30 million litre ginger storage terminal to enhance security. Of course, that was some of your top stories, giving you a little bit more of what the country is preparing for in terms of the East African crude oil pipeline, which has faced a lot of criticism, especially by environmental activists from various Western countries, including very many investors that have been pulling out of the project due to what they say is going to be a negative impact on the environment. We are going to go into a short break, but otherwise we return with the interview we held with Mr. Chitamirike, who is the CEO of Alltex, and he will be taking us through what to do in case we are to invest using the ZABO initiative that was, of course, brought about by Alltex East Africa. We'll be back. Don't go anywhere.